Welcome to this week's edition of Weigh the Options. Weigh the Options is a video series where I take a look at 5 potential options trades that I'm considering for this week. Now do note that Weigh the Options is a members only video series. Members of the channel get immediate access to these videos. If you're not a member of the channel, unfortunately you have to wait 1 week before you're granted access to the video. So please consider becoming a member. Click that join button, become a member of the channel for only $5 a month, and you will be granted access immediately to each and every Weigh the Options posted every Monday. So the first ticker I'm going to take a look at is GM, General Motors. Now GM reports earnings tomorrow morning. It actually reports before the bell. So you've got to put on a trade today, which is one of the reasons why it's important for you to be a member of the channel to get immediate access to this video, because if you're watching this a week later, this trade will have already happened. But for me, I want to trade General Motors on earnings. It has an IV rank of 40, which is pretty good. It has an IVX of 43%, which is pretty good. 39% in the 60-day cycle, which is the December cycle, which is probably the cycle I will trade. Because with General Motors, I think what I want to do right now, General Motors is trading at $58 a share. It's had a nice little run up here with the market as the market rebounded back in April. You know, it's participated in that market rally, but it's sold off quite a bit here in the last 2 or 3 weeks. I think what I want to do, though, is I'm going to sell both sides of the trade, because with the IVX being rather nice at 40%, you know, it's pretty good for a product like GM. It's not a tech stock. I think what I want to do is do a strangle. So if I take a look at the 60-day cycle, I've got to say the bid-ask spreads in this cycle are not great. One of the things I've noticed with the market here in the last week, the bid-ask spreads on some of these products has gotten really wide. General Motors is usually decent as far as liquidity, but yeah, I'm not liking the really wide bid-ask spreads in the December cycle, so let's stick to the 32-day cycle. Anyway, it's an earnings trade, so many times if you get the move you want, which is no move at all, the 32-day cycle is as good as the 60-day cycle, so let's go to that. And the bid-ask spreads in here are also, on some strikes, not great, but on others, it's okay. The 52.5 strike, which is going to be an older strike, so I think, and that's, yeah, it's got more open interest. You can see the $2.50 wide strikes have good open interest, and everything else has zeros. So these are brand new strikes, the dollar wide strikes. So let's avoid those and stick to the $2.50 wide strikes. So let me sell a 19 delta put, and then go on the call side and maybe sell the 13 delta call, because it's one of the $2.50 strikes. Overall, I'd get a credit of about 141 on a buying power reduction of $577. Risk versus reward, that's great. Not very much buying power reduction, right? Because it's a low price stock, and you know, it's not a terribly volatile stock. It's not going to hurt you too bad most of the time. You never know. Could GM, you know, move up and down, you know, $30 on earnings tomorrow? It's possible, but I wouldn't expect it. Probability of profit on this trade is 74%. So if we hold it till expiration, which I would never do, but if we did, this trade would win 74% of the time. For me, I manage my trades at 50% max profit. So anytime the trade gets to 50% of max profit, I'm going to take it off. And the P50 number is 85%. So I'm going to win 50% or more 85% of the time. So that's great. Very high probability trade, like the risk reward. All signs point to go on that trade. The next stock I'm considering is another earnings play for this week, and that's IBM. IBM currently trading around $283 a share. It has an IV rank of 48, and if I go to the options chain, it has an IVX in the 60-day cycle of 36%. So that's the December cycle. And if I take a look at the options chain, liquidity in here is not great. $1 wide spreads, $2 wide spreads. I go to the November cycle, does it get any better? Not really. Very similar. So I'm going to go back to the 60-day cycle. So here's what I do. If I want to trade something and the bid-ask spreads are a little crazy, keep it small and don't do naked options, because you're going to get screwed in a big way on both the entry price and the exit price when you sell a put, sell a call, or sell a strangle. Well, in this case, I'd like to do a strangle, but I know the pricing is going to be funny, and if I really wanted to trade this, which I kind of do, I'd do an iron condor. But let's put on a put credit spread. So I sold a 17 delta put and bought the put $5 below. You got a 93-cent credit on that. That's pretty juicy for being that far out of the money on that. And then On the call side, I want to get at least another 60 or 70 cents. So let's sell the 15 delta call and then buy the call $5 above. We get to 142 credit on a max loss of 358. That's pretty good. I typically want to risk about 2 to make 1. And if I actually move the call spread up for 1 strike each, and now I get to 155 credit on a max loss of 345, I think that's what I would do. Now, IBM reports earnings later in the week. They report after the bell on the 22nd. So that is after the bell on Wednesday. So I wouldn't put this on today. On Monday, I would wait until Wednesday afternoon, because who knows where IBM is going to be trading, in the next 2 days. It might make a big move up or down. So I wouldn't put on this iron condor today. I would wait until Wednesday afternoon to put this on. As it stands with the strikes as they are, again, the strikes will probably be different on Wednesday afternoon, but this trade has a pop of 64%, which is about what you would expect. If you're risking about 2 to make 1, you'd expect to have a pop somewhere around, 60 to 65%, somewhere in that general range. P50 number, though, and this is the key number for me because I manage at 50%, 85%, right? The P50 number. So again, a very high probability trade, and that's what I want. I want to win on most of my trades. I like to win about 90% of the time on my trades, and 85% fits me just right. So the next stock I want to take a look at is CLF, which is Cleveland Cliffs. Now this is interesting because this reported before the bell today on Monday, October 20th. So earnings has already passed, right? We already missed the move. It made this move, this huge gap up this morning. So Cleveland Cliffs was trading around 1330. End of the day Friday. It's trading at $15.45 right now. So that is a gigantic move in a $13 stock, right? And that's a up move of more than $2 on a percentage basis. You can see 16%, right, up on the day. Now, why do I want to trade it after earnings? It's because that was such a big move. IV rank is still high. The IV rank is still 31. The IVX in the November cycle is 78%. In the December cycle, it's 83%. Let's go into the December cycle, because if there's decent liquidity, like I don't mind going and selling some 22 delta puts for 69 cents on a buying power reduction of 181. Because a lot of times when you get these gap ups like this, on good news especially, there will be some continuation. Now, you might have some people taking profits, but it's not coming all the way back down to $13, right? At some point, it's going to continue going back up, or maybe it'll find a range. I feel pretty comfortable selling a few of these puts, 2, 3, 4 of these puts on a buying power reduction of only 181 per contract. I think it's a smart trade. If you wanted to, you could sell some calls against it, because the calls are kind of juicy. You can go all the way out to this 22 strike call, which is the 15 delta, but well out of the money. That's $7 out of the money. Just adding that to the 22 delta put, if you wanted to make it a little bit more safe, right, a little more delta neutral, that's a 99-cent credit on a buying power reduction of only 182. For me, this is another trade that just screams, yeah, perfect, right? All signs point to go, right? The premium versus the buying power reduction, you don't get opportunities like this very often. And because it's already had earnings, right? Could it still have some big moves? Sure. But the big 16% up move, that's already happened. So I don't fear the call side as much. But these calls, they have so much skew. We can sell that call so far out of the money. I love this trade. So we've done 3 individual stocks. Let's take a look at some ETFs. Here's a couple of ETFs I haven't traded lately, and I've been thinking about getting back into, especially as some of the tech earnings are about to get reported in the next couple of weeks. ARKK. So that's the ARK Innovation ETF. ARKK has had a big run up this year, as tech has had a big run up. So this ETF, again, a lot of tech names. And it's a good way to place some of these earnings. It's going to have some elevated IV because of the components of the ETF, but it's a good way to play the earnings without having single stock risk, right? You don't want to have single stock risk in some of the names like Tesla and Coinbase and things like that. I'm not exactly sure what the components of ARKK are these days, but you can go play some of those high flying tech stocks without playing the individual names. So let's go into the 60-day cycle, the December cycle. You can see it has an IVX 52%. Pretty juicy IV, right? So liquidity, again, I don't love liquidity, but this is across the market right now. For whatever reason, bid-ask spreads are really wide on some of these products. But if we're careful about the strikes we pick, we can probably find something with a bit of a tighter bid-ask spread. Yeah, I'm not loving liquidity in the 60-day cycle. Let's actually go back to the November cycle, the 32-day cycle. Yeah, bid-ask spread's much tighter here, especially on the $5 wide strikes, like this 80 strike, which is the 22 delta put. 190 credit, buying power reduction of 837. I don't mind that. If I wanted to make myself even safer, go to the 75 strike, because I'm avoiding the dollar wide strikes. They get a little wider. They're not terrible, but the $5 wide strikes are a little better. So the 75 put here, the 13 delta, I get a 109 credit, buying power reduction of 750. I don't mind that, but I think I want a double dip, right? So let's go find the call. Let's go find a 12 delta call, the 105 call here. Well, now I get a total of 176 credit on a buying power reduction of 895 for me. Yeah, I'm going to go ahead and ship that because, again, that's a great way to get some of the volatility of some of the upcoming tech earnings, sell some premium in some of that stuff without being in the individual stocks themselves and having some of that individual stock risk, right? Because the ETFs are not going to move as much as the individual stocks if you play the individual stocks. Another ETF that is good to get into if you want to play some of the chip names, right? So if you want to play AMD and NVIDIA and Broadcom and Qualcomm and all of that stuff, right? SMH is the semiconductor ETF. So it's a great way, again, to play some of those semiconductor earnings without taking the extra risk involved in trading the individual companies themselves. So SMH, what I would do here, IVX, 40%, go to the 60-day cycle. Liquidity's not great. It's not horrible, though. It's borderline. I could easily do a iron condor in here. I think that's what I would want to do. If I can sell the 16 delta put and then buy the put $5 below, 63 cents, that's about the minimum I would want. And then on the call side, let's see if we can get at least 60 to 80 cents on the call side. So sell the 18 delta call, buy the call $5 above. We get 136 credit on a total buying power reduction of 364. So our max loss is 364. Our max winner, our credit is 136. Now, if I wanted to bump that up, I could lean a little more in on the put side. So make that 18 delta put instead of the 16 delta put as far as the short put. Now I get a 148 credit. Now, much better credit. Well, a few bucks better credit. So now I'm risking about 350 to make about 150, and that's about the ratio I like on these $5 wide spreads. Of course, if you want to make it a bigger trade, I keep these spreads small for those with smaller accounts that are watching the video, but if you got a bigger account, you wouldn't do the $5 wide iron condor, right? You'd do a $10 wide. Right? Matter of fact, I can show you that as an example. Let's make it a $10 wide. Now you receive 273 credit on a max loss of 727, right? Because 273 minus $10 wide on the spread, 727 is your max loss. You want to get an even bigger credit and risk a little more money, maybe go $20 wide. So on this here, maybe you're trading with a 100K account, or 150K or 200K account. This would be something much more appropriate for those folks, where now you're getting a 468 credit, max loss of around $1,500. Yeah, and again, pop 64%, P50 around 85%, very similar to the previous iron condor we took a look at. And again, you get some exposure to some of the volatility of the chip stocks that are all about to report earnings without taking that extra bit of risk. Because if you go and sell some iron condors in NVIDIA or AMD, those things do have the potential to blow through your iron condor very easily, right? Those things can move 20% up or down on earnings and just blow straight through one side of your iron condor, no problem. But because SMH is a basket of all the semiconductor stocks, it's much less likely to go against you in a big way. So there you have it. That is this week's edition of Weigh the Options. Again, Weigh the Options is a members only video series. I publish these every Monday. For those of you that are members of the channel, you get access to these videos as soon as I publish them every Monday. For those of you that are not members, you have to wait 1 week. And of course, 1 week later, most of these trades are no longer viable. So please consider subscribing to the channel. Hit the join button to join the channel. Peace, guys.